Look at that, lots of fish.
And crabs.
Crabs. Look, and lobster. Is that a lobster?
I don't know.
It's quite cool. But wow, fish fauna. This is the fishiest lake I've ever seen. So I'm not in the office today, and I'm really glad I'm not, because it is absolutely amazing, the weather. So I've decided to come to Richterswil, which is a small town just up the, just along the lake, quite near to where I live. And I'm going to meet a really good friend of mine who I've known for a very long time. This is Paul.
Hey James, good to see you.
Good to see you too.
I love the jacket.
Really?
Had I known you were wearing that, I'd have brought some chess pieces along and we could
So
play.
I really like the polo shirt as well.
You're looking a bit cash today.
Yeah. Paul is he's got great dress sense. Right, so I'm overdressed, you're underdressed. That's fantastic. Paul, tell me a bit about yourself. What are you doing right now?
Well, James, I'm taking a bit of time out, and I've studied my own website and having a little go at flying solo just to see. Yeah, just
What's it called? What's it called?
It's called Investment Matters.
Investment Matters.
Yeah, and the URL is www.investmentmatters-comms.com. So a little bit of freelance work, some writing and consulting and that type of thing, see how it works out.
Yeah.
And if I get offered another permanent contract in the meantime, well, I could be tempted.
Paul is a bit of a fan of this game called Jenga, and he's going to use Jenga as an analogy to explain the state of the economy.
And then we're going to play chess afterwards.
And we're going to play chess. Right, so what is this exactly?
Well, James, you're obviously a multimedia expert and I'm not. And so I wrote this article called The Jenga Economy, and I have lots of followers on LinkedIn, yet virtually nobody read it. And I think
what? No, I read it.
I know you read it, and you liked it as well.
No, it was really good. Right. I thought it was quite funny actually.
Okay, cool.
It was great.
Cool. But the one thing that I hope to get with you helping me here is to get the message out to a few more people, because I think it's quite interesting, and if we do a quick video, maybe people will be more inclined to watch it than read my boring prose. So I've got a 3-base scenario here.
Okay, so what is this game about? I mean, I've played it before, but I've never really taken it this seriously, to be honest with you.
Right. Well, what I want to do is I want to put 3 different scenarios here, and basically we have a robust economy, which is the small tower. And here we have sort of a stimulated economy.
Right, okay.
And here we have a Jenga economy.
So this is the Jenga economy.
That's the Jenga economy. And that's where we are, I think, in terms of central banking policy, etc. I think the most important thing to remember is that it's called unconventional monetary policy because it's supposed to be unconventional.
So run through why it's unconventional. What is? I mean, there's a lot of people who don't really think about these things very much. I mean, we know that interest rates are low.
Yep.
But
super low. Super low.
But why is that a bad thing? Well, because it's been fantastic for me and my mortgage.
Actually, it hasn't been bad for me and my mortgage either. But normally interest rates move in cycles, just like economies move in cycles. And when you're stuck at a low level for too long, you get some economic distortions. And this is what I'm talking about with the Jenga economy. You see, it's actually full of holes. It's bigger than the other 2 economies, and it's full of holes. And it's full of holes because it's been bloated by quantitative easing and super low interest rates for ages. I mean, did you know, for example, the long-term interest rate averages around 6%? And, well, in the UK... I don't
remember it very well, but it was in the beginning of my career. Probably.
Yeah, well, in the UK, we've been around 0. Or a bit more, 0.5 for about 11 years, and that's pretty unusual.
It is, yeah.
And I think back to basically the big recession we had before the last one, the global financial crisis. I remember NatWest Bank were offering, this was 1992, they were offering a fixed term interest rate at 25 years at 9.95. Now, if you'd saddled yourself up to one of those, that would have been pretty extreme and pretty hard.
You didn't do that, did you?
No, of course not. No. But the point is that having these interest rates this low for so long creates distortions. Now, so you've got this robust economy here, and this isn't particularly intuitive, but you must think in terms of Jenga, that basically taking support away is raising interest rates. So how
You've got something to build on.
You've got something to build on. There's solid foundations here, and basically, if a central bank wants to take one of the bricks away, gosh, I'm not supposed to do this with two hands, but well,
cheating. But I guess that's okay.
The theory is it's possible for the central banks to take the bricks, take the support away, and you've still got a fairly solid economy, right? Here, you've got one choice. There's the only one that will move is this little brick here, and even that doesn't want to move. So central banks' choices are limited.
Right.
And here, because there are so many holes in it, we're using the example of the Federal Reserve. They've actually removed support on 4 different occasions by hiking interest rates, but I ran out of bricks, so we got 3 here.
Fair enough.
And basically what we're finding out now is that the economy cannot survive without being shored up a bit. So rather than taking the bricks out, what they're trying to do is
help you cheat.
Yes, you should help me cheat.
So
you're actually
accidentally destroy the economy,
putting them back in. And so interest rates are now on the way back down again. Now, I know what you're going to say next, James. You're going to say to me, what does this mean for equity markets?
What does this mean for equity markets?
It's a good question, and one I shall attempt to answer. Rather counterintuitively, I'd be happy to invest in equity, a little rider on the end there, to invest in equities in a Jenga economy scenario than this scenario.
But wouldn't, like, in a Jenga scenario, wouldn't everything just get hit? I mean, it would be equities and bonds and
basically the whole tower is going to come down at some point,
yes.
But I don't think it's going to come down yet, because with the Federal Reserve cutting interest rates once more, that brings the lower for longer scenario in. Now, I always like to talk about the price-earnings ratio. And the price-earnings ratio, if you look at, there's a really good site Dr. Robert Shiller does, and it's called irrationalexuberance.com. And basically After the book, yes. And after Alan Greenspan's famous quote in 1997. And what he's got there is a fascinating chart, and you can download the data, and it's free. And it has price-earnings ratios going back for years, and it has long-term interest rates going back for years. Now, the interesting thing is that you'll see that the price-earnings ratio typically dips to its lowest point, which means equities are at their cheapest, which means the market's probably taken a bit of a fall when interest rates are high. And the other point about it is, and this is where we come back to the percentages and why this is quite so interesting, is the long-term average price-earnings ratio is actually 14, and the reciprocal of that is 7. And so 7 is the earnings yield, or the enterprise cost of capital, whichever way you do it. Now, I told you earlier, do you remember what the long-term interest rate average is?
6%?
6%.
Which is pretty high.
It's pretty high by today's standards. But that's why you get this PE ratio averaging 14, because enterprise capital at a bit more than the cost of going to a bank is just about where it should be. So the point is, if we go into a lower for longer scenario and we say that, I don't know, let's just pick interest rates remain in a range from 0.5 to 1.75, that gives you an enterprise cost of capital of about 2 to 3, which would support a price earnings ratio of anything from 30 to 50. So wow. Considerably north of where we are now. everything's relative. None
Yeah,
of us,
exactly.
none of us know what's around the corner, James, and I wouldn't advise anybody who's nervous to invest in equities right now. But the lower for longer scenario is potentially supportive, and I'm willing to consider it. James, I think the point we come back to is it's incredibly unstable. But when is that instability going to result in everything falling over a bit like that?
Well, that's the point. I mean, the thing is, you don't know when that's going to happen. And I got really worried last week. A few weeks ago, I started saying, it's really bad right now. Negative interest rates, inverted yield curve. Something's going to happen.
Yeah.
And then somebody on my part of my network said, James, you don't actually know when that's going to happen.
No.
That could happen tomorrow.
Yeah.
It could happen in 2 years' time, 10 years' time.
Yeah.
We don't know. So the point is not about worrying about when it's going to fall over.
Mm-hmm.
It's about understanding the risk of what might happen
Yeah.
and trying to factor that in.
Yeah, but I think all the time that the Federal Reserve are trying to put bricks back into the tower rather than taking them out, it becomes a little bit
Weaker.
more stable.
You get stable, or
Yeah,
does
it
it get
gets.
weaker?
Well, they've taken the bricks out already, and as I said, it's a bit counterintuitive because we must think about removing support as raising interest rates and putting bricks back in as cutting interest rates, which is what they're doing now. And so if they've put one brick back in, that'll give it some short-term stability. They'll put another brick back in, that will make it even more stable. But the one thing that's got to change...
So they're not trying to build it higher, they're
No,
just trying to make it more
no.
stable.
Exactly.
And like you were putting the bricks in there.
Yes.
Got it.
Yeah, exactly. The point is, the big cliche is when will monetary policy normalise? And I don't know what normalise means, but it probably doesn't mean 6% interest rate. So it's not going to take it back to any long-term averages, but we need, at some point, to get away from the near zero interest rate policy. And if you look at Japan, they've been stuck there for about 30 years.
Yeah.
So it could last for a long time. We thought when it all started in 2008, when interest rates were slashed and then quantitative easing started in late 2008 in the US and in March 2009 in the UK, we all thought it was just a short-term measure, but it's proved to be anything but that. And out of this long-term scenario, we've built up a Jenga tower which was going to fall over at some point.
Bye, Paul.
Bye, James. Good
Thanks
to
for
see
playing
you.
Jenga.
Pleasure.
Really cool, huh?